Stocks, bonds, ETFs, straight out of downtown Chicago. This is Zacks Market Edge.
Welcome to Zacks Market Edge, the podcast about investing in your life. I'm your host, Tracy Reineck. And this week, we're wrapping up 2024 with a fun podcast on the Magnificent Seven. Now, we all are in them. We've all owned at least one of them. We own them if we own the S&P 500. And, that's key. But sometimes we want to own them as individual stocks too. Which ones should you buy for 2025? That's what I want to talk about this week. They've run big here in 2024. So I'm sure some of you are thinking, why would I be buying when they're all at their highs? But some of them still have attractive valuations. They aren't the ones that are sky high with PEs of 200 or price to sales ratios of 65. Those are other tech stocks. That's not the Mag 7. So which ones do I like for 2025? And what ones should you be thinking about watching for the year, especially on any kind of pullback? There's only 7 of them, and let's go over what those 7 are, because sometimes I have a hard time myself remembering who is exactly in the Magnificent Seven, because we had the FANG Man, and now we have the Mag 7. That's basically because people wanted to include Tesla, but there was no room for it in FANG or FANG Man because there's no T. So we kicked out Netflix, got over with Tesla into the Mag 7, and that's how we got this new, grouping of stocks. So if you recall, it is Apple, Amazon, Alphabet, Meta, Tesla, NVIDIA, and Microsoft. So I always forget Microsoft is in there because that has been one of the not so great performers this year. Even though it is up on the year, it hasn't had quite as big a gains as some of the others. But should you be buying that one into 2025? I'm going to cover 3 stocks that I really like out of this group of 7. And we're going to take a look at some of their fundamentals, because that's the story on why I like it. But first, let's talk about the valuations, because everybody is assuming that these stocks are quote unquote expensive, but are they really? I took a look at the price to sales ratios on all 7 of these stocks, and it was kind of eye-opening to see what those are like. Now, if you remember, a price to sales ratio of 1 or less means it's a value. And price to sales means I am paying, say if it's 0.7, so it's under 1 at 0.7, I am paying 70 cents for every dollar worth of sales. So I'm getting them on sale. That's why anything under 1 is considered a value, because I'm getting them at that discount. But anything just slightly above 2, 3, 4, that's still pretty low, even though I am paying more than what the sales actually are to buy those sales, but not a lot more. So that's still very attractive. But once you get at 10 or higher, people start to give a little bit of the side eye. Why are you paying that much for every dollar worth of sales? So I'm paying $10 for every dollar. Or if it's 20 or 30, or in the case of Palantir, 65, then I'm paying $65 for every dollar worth of sales. And then you do have to stop to think, why? Why am I paying that much for that dollar worth of sales? Is it really worth that much to get that dollar worth of sales? Now, as you know, I'm the value stock strategist here at Zacks. So I tend to aim more towards the value type of stocks, but I like myself a good growth stock too. And I do own stocks that trade with price to sales ratios over 10, but you still have to be a little cautious once you get to those levels. Now, a lot of the old timers will tell you we started to see a lot of the big tech companies get above 10 on the price to sales ratio in 1999 into 2000. And back then everyone was like, oh, don't worry. The revenue's there, the growth is there. I'm buying the growth. I don't care if Microsoft's trading at 10 times on the sales, but then ultimately the market did care. And that's why those stocks took a tumble until the valuations actually got more in line with what the company was producing on sales and earnings side of things. So keep that in mind. Things can definitely run for a long time at these higher price to sales ratios, but eventually valuations do actually matter. So I kept that in mind when looking at the group, and I took a look at the price to sales ratios on all of these stocks. So let me just read it off. The cheapest is actually Amazon. Ticker AMZN, as you know, 3.9 is the price to sales ratio. So that was the most surprising to me. I didn't realize that their price to sales ratio was that low, but remember, it has a lot of different parts to the business. It's got groceries with Whole Foods. It's got the marketplace with its website. It's got AWS. So there's just a lot of things going on there that might result in the price to sales ratio being this low. Then we have Alphabet, and they are very attractive at, where's my Alphabet? 6.8. So that is under 10. That's pretty cheap. As I've talked about on prior podcasts when I said, hey, why isn't Warren Buffett taking a look at Alphabet? I think he should be, but it's not at the value. It's not under 1. None of these are, but it's still pretty attractive under 10 there at 6.8. Then we had Apple. And this is a surprise too. And maybe this is why Buffett is actually selling some of his Apple, because they have a price to sales ratio now of 9.6, almost at that 10 level. So that's pretty pricey for any company, but certainly one that's a little slower growing, which Apple is now. So 9.6 for Apple. Meta is right at 10. Microsoft, looking at it now, 13.1. Microsoft. So if 10 was pricey in 2000, is 13.1? I own Microsoft in my own personal portfolio. I don't know. It gave me some pause there when I saw that. Then we have Tesla, 14.4. That's pretty pricey as well for a car company. Then if we've rounded off with the one we all know is pricey, NVIDIA at 29 times. But that seems kind of cheap compared to, again, some of these other tech names like Palantir, which I mentioned earlier. That ticker is PLTR. It's busted out. It's up over 300% this year. It's at new highs, but its price to sales ratio is 65. You're paying $65 for every dollar worth of revenue there. So 29, that doesn't sound so bad. And NVIDIA's doubling its revenues this year, and another double-digit growth for next year. So I'm still liking the fundamentals on NVIDIA, but it's not among my 3 best buys for next year. It's kind of on the cusp, though. It would be number 4 if I was going to do 4 stocks. I've talked about NVIDIA a lot this year. I still like it. It's pulled back 10% off its highs when I'm recording this video. So if you can get NVIDIA on a correction or a bear market, 20% down, you might want to take a look because it's cheaper and it still has this growth trajectory. I still like it into 2025 and even 2026. So take a look there at NVIDIA. But let's start and talk about the companies I do think are even better than NVIDIA for 2025. And we are going to start with the one I said Warren Buffett should be buying. It's Alphabet. Ticker GOOGL. I own it in my own personal portfolio. I've owned it for about 7 years now. But stock's breaking out to another set of new highs. It's year to date up 41%. So it's not quite as hot as some of the others in the Mag 7, but still outperforming the S&P 500, which is up about 27% on the time I'm recording this. So let's take a look on Zacks.com, as we always do, at what is the fundamentals looking like. It's a Zacks number 3 right now. It has a B for the style score VGM, the overall. It's got A for growth, B for momentum, and a C for value. So C is not too bad. As I've said, with any of these, none of them are really cheap where they're going to get an A or a B for value, but Alphabet is among the cheapest on various metrics on the Mag 7. So I already talked about how it has a pretty low price to sales ratio of 6.8. Its PE is 23.7, even though it's busting out to new highs. Price to book ratio is 7.4. I look for 3 and under for a value stock, but 7.4 isn't terrible on price to book. And PEG is at 1.3. And that's because, as you can see, I'm showing the price consensus and surprise chart, and you see some very nice earnings growth. After that turn down in 2022, it's, having this nice uptick here, very steady growth expected. It now is paying a dividend. It's yielding 0.4%. It's not a lot, as those of us know who own it, but I'm getting something. They're sending me a check, so I'm fine with that. Also, one of the things I really like about Alphabet has been YouTube. They did just recently raise the price on YouTube TV, outraging many people who get YouTube TV. So I'm not sure how that's going to turn out. But the advertising on YouTube has been just a huge growth engine. Over the last 4 quarters, YouTube alone has taken in $50 billion in revenue over those 4 quarters. And the growth is still there. So we'll see what happens in 2025 with YouTube. But I basically own Alphabet for YouTube now. And they could spin that off if somehow they have to divest of certain things in this antitrust case that's going on through the Department of Justice. But if they spun it off, I would be happy to be a YouTube owner with just that as a standalone. So, Alphabet, let's take a look at the detailed earnings because it does have that low PE for these Mag 7s. So, 2024, 38% earnings growth expected. That is coming down for next year, just 11% right now. But that's still double digits with, the couple $1 trillion market cap. On the revenue side, expected to make $294 billion this year, $330 next year. These are phenomenal numbers for a company of this size to do the double digits. And again, even though the stock is busting out, it is very attractive on these valuation metrics. It's not overheating right now. So that's why I like it. Let's take a look just at that price and consensus chart again, because we had the earnings surprises in there. And you can see, I like to look at these things of beauty where we're getting the nice double-digit earnings growth up and to the right, but very steady. The analysts, not a lot of surprises there. They are pricing in this nice earnings growth and nice for 2026 as well. We are not getting that yet on the detailed estimates page because we're not in 2025. But once it turns over, you'll see that it's looking like another double-digit earnings growth from the analysts for 2026. So that's Alphabet, ticker GOOGL. Okay, so let's switch to the second one I really like. And I used to own this. I don't own it anymore. It's Meta Platforms. I've talked about how I owned Facebook originally. I owned it for many years, but then when they became Meta and they were doing the metaverse, I wasn't a big fan. I didn't see what the point of that was. So I got out. Like, if you don't like the underlying business, don't own the company. And now they've kind of gone away from that and they're embracing the AI. They really have the advertising going. They have Threads now in addition to Instagram. And WhatsApp is doing well as well. So Meta kind of transforming itself this year, up 76% year to date, kind of quietly because NVIDIA has been getting all the glory along with Tesla. So this year, not as many people paying as much attention to Meta Platform stock and what it's doing, but up 76%. I talked about price to sales. It's at 10. And PE on this one, only 27.4. So that's pretty cheap. PEG of 1.4, also really cheap. Remember, a peg under 1 means growth and value. So that's really cheap. Price to book, 9.5. That's not too bad. So even though this is busting out to new highs as well, it's still pretty attractive on valuations. That's why I like it. It's a 3 on the Zacks rank, as you can see. Style scores, also a B for the VGM. This is identical to Alphabet's. C for value, A for growth, B for momentum. And that's also why I like it. It's not, valuations are not stretched here. Dividend, they're paying 2.3% on the yield. So a little bit less than on Alphabet, but you're getting something, $2 a share. And you can see on the price consensus and surprise, they put together nice earnings surprise track records since 2023. They haven't missed. And then we've got up and to the right as well with the earnings on Meta platforms. But what does that look like on the detailed estimates page? Should be double digits as well. And this year, earnings up 52%. Revenue up 20.9, very nice revenue growth, up to 163.1 billion expected. Next year, 187.1 billion, up another 14.7%. Earnings up 11% for next year. But like with Alphabet, we have the 2026 on the price of consensus chart, and that's looking like another double-digit gain on this chart, as I just put up just the price of consensus chart. And you can see it's nice earnings growth. Again, just like with Alphabet, the analysts are in the know. There's not a lot of surprise here. It is up and to the right with the nice double digits growth, but analysts expecting kind of, smooth sailing here for 2025 and 2026, but we'll see. Stock is breaking out, as I mentioned, but still very attractive here. And I'm liking Meta platforms for 2025. Then my third choice, this one I also own. So I own, out of the Mag 7s, I own Microsoft, Amazon, and Alphabet. And so I just happened to pick 2 out of the 3 that I also own. But Amazon, I'm very surprised at what's going on there this year. Amazon.com, as it still says on Zacks, because that is what its name is really known as, is a Zacks number 2 rank. So we've got the buy ranking on the Zacks rank, which is the short-term recommendation, just 1 to 3 months. Style scores, it's a little different here because it has a D for momentum, but overall score for the VGM is still a B. It's a C for value and an A for growth, just like the other 2, but a little less on the momentum, the D for momentum. Scrolling down, you can see these charts all look kind of the same, right? I have to scroll up. Does say Amazon. Because if I didn't know better, I would have thought this was the Meta chart because it had the misses in 2022 as well. And it hasn't missed on earnings since the start of 2023. All these charts look the same. It's also busting out to new highs. It's got the double-digit earnings growth expected for 2025, 2026. Very crazy that these all look the same. Now, year to date, this one's up 53% to this new breakout. This is a big breakout, I feel, for Amazon as well, because it was kind of just moving sideways a lot during the pandemic. It did get to those highs, but then moved sideways. Then it broke down. Jassy came in as the new CEO, did a lot of layoffs, made some decisions on certain of the businesses. And now we're seeing kind of the fruits of that. Amazon also taking in a lot of advertising revenue now. So I do like that aspect of what they're doing, but they're also getting into AI in different ways through building data centers with AWS in the cloud. But also they are developing their own chips and getting into the chip infrastructure in the data centers, the liquid cooling, the racks, all of that. I like that they're going into that area because there is an opening and there is a lot of business there. The data centers are going to be built not just in the United States, but globally. And that's not going to slow for several years. So this is still a very small part of what is their overall business. But I like that they're going into these new areas and they're willing to talk about it. They are partnered with some of the big chip companies as well, obviously for AWS and to, service those customers. They are still with the big chip makers like NVIDIA, but they are still also, exploring new avenues in this area of the business. So what do the rest of their valuations look like? We know they're cheap on the price to sales, 3.9, PE, 43.8. It's always been high, but it got down to around 40 before this recent breakout. I want to say that's the lowest I've seen Amazon at in forever, basically forever. So that's considered cheap for Amazon on a PE basis. PEG ratio of 1.5. So that's very attractive as well. Price to book 9.2, also attractive. So it just has a slightly higher PE, but otherwise I'm still liking all the numbers there. And taking a look at the detailed estimates, they are doing double digits revenue growth. They're back to that now in 2024, 10.9% to 637 billion. Next year, 706 billion expected, another 10.9%. These numbers are kind of crazy, right? You're bringing in 706 billion in revenue and you're still able to grow it by 10%. That is crazy. Current year for the earnings, 79% earnings growth. Next year, up about 20%. So those are both great too. I like all three of these. I'm a big fan of most of the Mag 7s. You can buy all of them if you want to just do that in the MAGS ETF. It is ticker MAGS. And that's up about 73% year to date. So if you don't want to bother with, should I buy this one? Should I buy that one? And you want to maybe be a little more diverse. It's 7 versus owning just 1 or 2 of them. Then why not? Why not do the ETF? It is obviously at all-time highs, but it's a relatively new ETF. It does have over $1 billion in assets in there now. So many people are just choosing that option to just buy the ETF. But if you're like me and you do like owning some of the individual names, these are the 3 that I really do like for next year. It's Alphabet, it is Meta Platforms, and it is Amazon as my 3 picks, with a side of NVIDIA, especially if NVIDIA pulls back further. I'm still a big fan. I don't think that the run is over in AI or the chip demand. I think it's only going to continue into 2025, but trees don't grow to the sky, as I've said many times. So there are always pullbacks. NVIDIA itself has pulled back many times in the last 2 years already during all of this AI revolution story. And some of these others have as well. We've seen big pullbacks in many of the Mag 7 stocks over the last 5 years. So if you feel like this is still a little too hot for me, then wait on the sidelines. There are always pullbacks and you can get them. So, that would be my advice for the Mag 7s going into next year. It's always exciting to do these end of the year podcasts. And I will be back to do the beginning of the year podcasts in the first full week of January. So I won't be back on New Year's week, but the podcast will resume in the first full week. And there's a lot going on next year. We are getting a new administration in Washington, and that could be a catalyst because they want to do a lot of deregulation. It could spur more animal spirits outside of AI in some other areas. And so that could be a big thing to watch for in 2025. But as I've said many times, the U.S. economy is on a fairly good track right here. The Fed is cutting. They may pause that in 2025. We won't know until it happens, but things are looking pretty good. Unemployment's not too bad. And so the stock market still making these new highs, at least in the tech names and the Mag 7s. But look for that pullback, as we're seeing now in NVIDIA, to maybe get in a little bit cheaper. And as always, you want to be listening to this podcast because I'm going to be bringing you other stocks outside of the Mag 7, as I always do. We're going to be running those screens and, bringing you those Zacks #1 rank stocks every week next year. So be sure to get us on YouTube. Speaking of YouTube, we have our great channel over there. I know many of you are subscribing, so be sure to subscribe on YouTube. Just go to Zacks Investment Research in the search bar. You'll find us, subscribe. You'll get stock picks, plus this podcast and a bunch of other, videos that we post weekly on that channel. But if you just want to listen to the audio, which I understand as well, get us on Apple. We're on Spotify. We're on Amazon Music. We're on all the Mag 7 platforms plus Spotify, basically. But we're on most of the podcast platforms. And I know you're getting us as just audio there. But be sure to get us somewhere. And I will, let me just do the tickers again, even though we all know what they are. But the three that I like: Alphabet, GOOGL, Amazon, AMZN, and Meta Platforms is Meta, META. And so with that in mind, I'm wishing you all great holidays and a happy new year. And I'll see you in 2025 with some more stocks.